Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I would like to share with you guys 5 companies that are still undervalued despite the markets going up quite a bit in the last couple of weeks. Right now, if you watch the stock market today, it looks beautiful, it looks great, it's all green. Majority of the companies, apart from just a couple of like Palantir and whatever, are down, but majority of the companies are doing absolutely amazing. And this is the time where everyone starts buying stocks, not when they're down 10% in a week. That's when everyone starts selling. This is the time where everyone buys, and that's why a lot of people lose a lot of money. And some people will start buying companies because they've seen them go up about 5% in one day and so on. And of course, some of these companies are overvalued. So what I'm going to share with you guys today is 5 companies that are still undervalued despite some of the companies like the S&P 500 basically doing well over the last few weeks. And as you can see here, the portfolio here is actually up just today almost to £2,500. Potentially it might be down tomorrow this exactly same amount or even higher. So it's been going up and down. So if you, for example, click last 3 months, you can see basically we were up and down every single week and so on. So again, we're probably going to continue doing that over the next few weeks. Basically for the last 3 months the portfolio is down over almost £11,000, which is absolutely crazy if you think about it. So what I'm going to do now is I'm going to share with you 5 companies that are undervalued right now, and every single one of these companies based on Morningstar, and every single one of these companies in my opinion is very high quality company. If you're enjoying this type of content, please don't forget to join us in the Patreon account. It costs you a tiny bit, but it really genuinely helps the channel, and you get access to the family portfolio and so on. Let's get started. I don't want to make the video any longer than it needs to be. As usual, we're looking for the same sort of information. We're looking for the market cap of the company to see how big the company is. We're looking for the moat rating, which means does this company have a competitive advantage over their competitors. Current price, we're looking for the dividend yield to see if they pay any dividends. The payout ratio, how much of their net income they're spending on paying that dividend, how much they've increased that dividend, the basically latest, the 5-year growth rate for that dividend, how long they've been paying that dividend, how much they pay, and how safe it is. Then we also need to know if the companies are profitable, if they actually take in our money and basically money they get from the bank and so on, and reinvest in that money to generate more money. So those are the return on equity, return on investor capital. So it helps us to see how effective management is. Then we want to see the free cash flow. We want to see if the company has a free cash flow, because that's the money they use to pay off any debt, to buy other companies, to pay any dividends, to buy back their own shares, and so on. EPS growth for the next year. We want to see the earnings per share expectations, basic growth expectations for the next year, and we want to see the revenue as well, because that's basically one of the in my opinion the most important thing about a company. If the EPS is growing and revenue is growing, of course the company is doing well overall, and they're going to be profitable and they will generate more free cash flow and so on. And then we're going to look at Morningstar valuation. This is not seeking alpha, and the fair value price for these companies. Right, let's have a look at the first company, and that is Merck. Merck is one of the companies that has been in my portfolio quite some time. It is so much undervalued at the moment, 42% according to Morningstar, and is one of the, I genuinely think, one of the best pharmaceutical companies out there. 195 billion market cap, has a wide moat. Current price is $77 per share. Dividend yield right now over 4%, which is absolutely ridiculous. I've not seen this company trade that much for dividend yield, basically over 4% for a very long time. The payout ratio is only 40%. Latest increase was 5%. The 5-year growth rate of 7%, and 13 years of increase in that dividend. You get annually $3.24. Dividend safety of 90%. The highest any company will get is 99%. Profit margin, return on equity, and return on investor capital, probably one of the best companies out there when it comes to pharmaceutical companies. Free cash flow over $17 billion, and EPS growth expectation for next year is 16%. Revenue is about 1%. Morningstar says it's basically a 42% upside from where we are. $111 per share is where they think the price should be, and the stock is down a year to date. It's almost to 22%, and actually Wall Street is saying it's a buy as well. And if you look at, you've got 12 strong buys, 3 buys, 11 holds, and no sales whatsoever. 30% upside from where we are. Almost $102 per share is where they think the price should be. The next company we're looking at today is Lam Research Corporation. This is basically one of the companies that we've been talking about it in the last few weeks because it is undervalued, just about 2% upside from where we are. It is one of the semiconductor companies, one of the biggest semiconductor companies. Just the Lam Research and the Applied Material and KLA are basically semiconductor equipment and material companies. Now, as you can see here, it's got 104 billion market cap, wide moat. Price right now is $83 per share. Dividend yield over 1%. The payout ratio 25%. Latest increase. The payout ratio tells us basically this company can increase that dividend as much as they want in the next whatever years. So because they're spending about 25% of their net income to pay us that dividend. So the fact that they've increased it 15% recently, that's absolutely amazing. The 5-year growth rate of 13%, a dividend streak of 10 years, and annually you will get about $1 per share. Dividend safety of 66%. Profit margin, return on equity, return on invested capital, again really good. Over $3 billion of free cash flow right now. They're expecting the earnings to grow about 32% and revenue about 22%. Like I said at the beginning, Morningstar basically saying 2% upside from where we are. $86 per share is where they think the price should be. And this is one of the stocks is actually up about 16% a year to date, but for 1 year is about down about 14%. Wall Street is saying is actually a buy. We've got 20 strong buys, 4 buys, and 9 holds. And as you can see, we got about 7.5% upside from where we are. $90 per share is where they think the price should be. These guys think it's about 86, so very close. The next company we're looking at today, S&P Global. This is one of my favorite all-time companies. It has a market cap of 156 billion. It has a wide moat, $517 per share right now. Dividend yield slightly below 1%. The payout ratio only 23%. The smallest that we've seen on this list so far. Latest increase was 6%. The 5-year growth rate of 10% and 51 years of increase in that dividend. Think about this. 51. A lot has happened in the last 51 years, but this company has been increasing every single year for the last 51 years. This is why you buy high quality companies that have been around for a long time, durable companies and mature companies that have excellent free cash flow as well, very profitable, and top of that they are growing nicely. EPS expected to grow about 8%, revenue about 5%, and 4% upside from where we are right now. $540 per share is where they think the price should be. Right now it's about $517. Looking at year to date, as you can see here, is about 8%, 4% up year to date, and for the 1 year about 20% up. But a strong buy from Wall Street, 17 strong buys, 8 buys, 1 hold, no sales whatsoever. 13% upside from where we are. $583 per share is where they think the price should be. Another high quality business that's actually down quite a bit. Now, that's basically undervalued at the moment. It's not down a lot for the year to date, like we've seen already here. Okay, but when it comes to undervaluation, it seems a little bit undervalued at the moment. Okay, next one is Hershey. This is probably one of the companies that has been down a lot, but when it comes to EPS and when it comes to revenue, it's not doing a great job, and a lot of that is because of this. And let me show you here. Okay, this is the price of cocoa. This is basically, of course, the whole product is basically the chocolate side of things. And if you look at the last 5 years, look where the price of cocoa was. And right now, basically 2024, it basically shot up to April. Basically, it's been for 1 year. For the last year, basically, the price of cocoa has been around the same sort of a price. And because of that, the company is spending now a lot more money to buy this cocoa. And of course, that squeezes the margin for this business. And that's why it's down a lot. But I don't think that's going to continue forever. Basically, the fact that the price of cocoa is down a lot. And I'm sure they're going to build the contingency plans and so on. So we'll see how it goes. But right now, the company is down a lot because of that. Now, if we look at the stock price for a year to date, is only 6% down, but when you do for the 1 year, it's about 21% down. So that's one of the reasons basically the stock is still down a lot. And in fact, if we go back here, you will see the 52-week low is 140. It's about 160 now, and the highest it's been is about $208 per share. So it has come down quite a bit. But when it comes to dividends, actually doing really well. So you want almost the 3.5%, 65% basically payout ratio, slightly high for my liking. The latest increase, they haven't increased it recently. The 5-year growth rate basically is about 13%. Dividend streak of 15 years. $5.48 is what you get, and safety is 80%, so that you don't have to worry about that dividend being cut or anything like that. And profit margin, return on equity, return investor capital, really good now. I don't know how long this is going to continue because of the fact that they're spending a lot of money to get, to buy those cocoa so far, but they do have a really good free cash flow, about $1.8 billion. And like I said, revenue basically and EPS is not doing well at the moment, but we'll see how it goes. 29% upside from where we are. And if we go back here, you will see the Wall Street is actually saying basically a hold. We've got 17 holds basically, and that's one of the reasons why Wall Street is not touching this company at the moment. So we'll see. But again, sometimes when Wall Street runs away from these companies, that's when I run towards it, if I understand why the company is down. Of course, don't just buy it because Wall Street is not buying it. Buy it because if you think the company, the price of cocoa will come down at some point and the company's profits will not be hurt and so on, then of course you need to basically you need to do your research and so on. And but I do own it, and I will definitely continue to own in the next few years, inshallah. Next one is EOG Resources, and basically energy company, 60 billion market cap. It has a narrow economic mode, $111 per share, 3.5% dividend yield, payout ratio only 32%, latest increase of 7%, and the 5-year growth rate 28%, dividend streak of 7 years. Annually you'll get $3.90, dividend safe to 82%, profit margin, return on equity, return on investor capital, probably one of the best out there, free cash flow over $5 billion. And again, is another company that is expected, and this is a very oil companies, energy companies are very cyclical businesses, similar to basically semiconductors. So right now basically they are out of favor, and of course that might change very quickly. The price of oil can go up, and for that reason the companies will generate more profit and so on. But right now when it comes to EPS and revenue is basically negative. Expect about when it comes to valuation, Morningstar is saying it's about 18% upside from where we are. $131 per share is where they think the price should be, and it's down about 9% a year to date, and for the 1 year it's up down about 12%. It's a buy from Wall Street, 13 strong buys, 6 buys, 14 holds, and as you can see here, it's about 22% upside from where we are. $135 per share is where they think the price should be. So another high quality businesses, and I think all of these companies are really great, but you're taking of course a bit of a risk, just like everybody, just like any other stock buying these companies. But I do own all of them, so this one is actually in the family portfolio. So if you want to check that out, go on to the Patreon account and you will get access to that, inshallah. I do own all of these companies, and from Sharia compliance side of things, nothing to worry about. You can pause the video and have a look at that as well. So if you're enjoying this type of content and you like what we're doing here, you like the transparency and everything we're doing here, I would genuinely appreciate if you can like the video, subscribe to the channel, share with your family and friends. And of course, like I've always said to you guys, I have a full-time job, and what I'm trying to do is share my journey with everybody else. And sometimes I might not post it regularly, but at the same time I'm going to do the best that I can, inshallah, to share my journey with the community. I've got a couple of videos planned for us, inshallah, portfolio updates, dividends, and all the income side of things, inshallah, all the buys and sales that I made for the month of May. So I'll be sharing with you guys that very soon, inshallah. Have a wonderful day. Assalamu alaikum.